Just as the market was celebrating the end of the government shutdown, the Fed threw a bucket of ice-cold water on the rally, and this wasn't just a mild cool-down. Wall Street was sent straight into the deep freeze. Stocks tumbled, bonds were dumped, and even the typically high-flying tech giants couldn't hold their ground. Even more alarming? Market expectations for a December rate cut were cut in half, literally overnight. Let's take stock of the damage. The three major U.S. stock indices nosedived as a group. The S&P 500 fell 1.7%. The Dow Jones plunged nearly 800 points. Real money, wiped out in a day. The tech-heavy Nasdaq collapsed 2.3%. And it didn't stop there. The bond market groaned in pain, with the 10-year Treasury yield climbing past 4.1%. A clear sign that big money is rushing for the exits. So why did the market suddenly break? Blame the lightning-fast shift in tone from Fed officials. Remember last month? The market was almost certain we'd see a December rate cut. Now, those odds have been slashed to below 50%. Who's behind this reversal? The Fed's hawkish faction. Take Minneapolis Fed President Kashkari. Just months ago, he insisted rate cuts were needed this year. Now, he says we should wait and see. Even more stark was the Cleveland Fed chief, who declared interest rates must stay higher for longer. The flip-flop is stunning, but the Fed's newly tough stance isn't without cause. It boils down to one word: inflation. Yes, oil prices have dipped recently, but U.S. inflation remains stubbornly stuck around 3%. Worse yet, wages are still rising, and consumer spending shows no sign of slowing. How can prices meaningfully fall under these conditions? Add to this the flood of economic data about to be released now that the government has reopened, and it's no wonder the Fed is hesitating to make a move. Don't be fooled by talk of a technical adjustment. This isn't a minor fluctuation. It's the market repricing reality. For months, Wall Street bet the Fed would keep the liquidity flowing. Now that it's clear that bet was wrong, the scramble is on to exit positions at any cost. The hardest hit? AI concept stocks. After being hyped to the skies, many are now crashing back to earth as their earnings fail to justify those sky-high valuations. So what should ordinary investors do? Small Orange Diamond first. Don't rush to buy the dip. With the Fed stance still uncertain, market volatility is far from over. Small Orange Diamond second. Steer clear of overvalued stocks, especially those riding hype cycles. Trying to catch a falling knife is a dangerous game. In the end, this market turmoil teaches us one crucial lesson. Never base your strategy on a single expectation. The Fed can change its mind in a heartbeat. Wall Street veterans can reverse course faster than you can blink. As individual investors, our best move is to stay clear-headed, stay prepared, and keep our footing, no matter how turbulent the markets become. We'll leave you with a question. Do you see this market shakeup as a crisis or an opportunity? Share your perspective in the comments. Stay tuned for our next update, where we'll keep breaking down the real drivers behind the economic headlines.